Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending August 20th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is where will the markets go? Is there a bigger move coming? Um, so why don't we just jump in and take a look at this past week? We'll take a look at index activity across Europe, the U.S. and Asian markets, and we'll take a look at some economic data out of the U.S., Europe, and then the Asian markets. And we'll go take a look at some charts. There's one chart, though, that I want you guys to pay particular attention to. So first up, let's go take a look at the index performance and just kind of where we're going through sound bites here. Let's take a look at the U.S. first. Everybody finished in the red this week. Even given the strong finish on Friday, everybody was down pretty good, strong amount during the week. The Dow was down. The Russell really took it. They were kneecapped this week, down to a little over 2.5%. However, everybody year to date still in the green. The Russell, which was leading the way through most of this year, has been pulling back. The winner right now, the S&P is up strong, 18.25%. If you look at the valuations in the markets here for the U.S. markets, you can see that the forward PE ratio is still pretty high at 21.97, and the dividend yield in the S&P 500 still over 1.34%. The 10-year Treasury coming in at 1.26%. So the 10-year Treasury is 8 basis points. That's 0.08% lower than the dividend yield in the S&P. And anytime you have the Treasury lower than the S&P dividend yield, you're going to generally see money flow into the S&P. We are having money come into the S&P. The inflow is very strong. That's keeping the markets up along with earnings. Members, we go through a lot more detail, the earnings by sector and valuations, so that you can tell which sectors outperforming others more easily, and where we expect to see growth and lack thereof. The current volatility, the VIX closed out the week at 18.56. You can see it was up over 16% for the week. The prior week it closed at 15.45. So we had, a down week all in all. The best performing sector for the week, and not surprisingly, utilities. They tend to do better as a proxy for bonds in the equity market when the markets pull back. It finished the week up 1.82%. The worst performing sector is energy, down a big whopping 7.14% on the fear of limited economic growth globally will dampen the demand for oil and energy. Sector performance, we finally upended energy. It was leading all through the prior Friday year to date, and then the real estate sector took over 30.68%. Energy is just slightly behind it, but the real estate sector, XLRE, is winning year to date. Staples is bringing up the rear at 9.16. So even the worst performing sector year to date is still solidly in the green with a whooping 9.16% as we're moving higher. Okay. Now, if we just take a look at some of the economic data that hit last week, we are getting emerging signs of a slowdown, across the Asian markets. More on that in a minute. We did see the markets going through the week. The Feds released their minutes in the middle of the week on their latest policy meeting the prior month. Most members are saying that they think tapering could happen by the end of this year. Yet we had a pretty good move up on Friday when the Dallas Fed President Kaplan came out and basically suggested that he may favor delaying the tapering and into January, February of next year if the Delta variant continues to take a deeper bite out of economic activity with all these slowdowns here in the U.S. I mean, we're seeing it now primarily in Japan and the Asian markets and over in Europe, but it's really starting to take hold in some of the blue states here in the United States, right? Blue meaning politically, democratically controlled. So we're seeing some of that. We're also seeing retail sales slumped in July 1.1%. So that also dampened the mood a little bit. Housing starts fell over 7%. Building sentiment fell to its lowest level in a year, even though the real estate sector had the strongest week in quite some time. But we're seeing still a problem with supply worries, supply chain issues, trying to get labor on site. Still very difficult to do. Industrial production did move up 90 basis points in the month of July. Weekly jobless claims fell to 348,000, bigger drop than people were expecting. So that's good news. And we now hit a pandemic era low for jobless claims. So that's pretty good, right? Now, if we come over and we look at the Treasury market, Treasury yields pretty much fell throughout most of the week. The yield on the 10-year, which is the annual benchmark against risk-free investing, touched its lowest level since August 5. Okay, most of it going down on fears around the Delta variant, dovish sentiment from some of the Fed policymakers, and weaker than expected retail sales, kind of supported the rally in bonds. And as you guys know, whatever direction the bonds move, interest rates move in the other direction. So that's kind of what we saw across treasuries here in the US. And then over in Europe, same thing. Most stocks, and let me just get that up here so that you guys can see. Over in the European theater, everybody was in the red for the week. Everybody. The Euro stocks, FTSE, CAC 40, DAX, all across Europe in the red. They're still solidly in the green, though. And the CAC 40 is up 19.36%. That's the French index. So still in the green, right, for the French or for Europe. We're seeing also the Eurozone bonds. They kind of drifted lower like they did here in the U.S. with the 10-year. Inflation in the Eurozone increased 2.2% for July, up from 1.9 in June. So like here in the U.S., we're starting to see stronger inflation. And the central bank target, the ECB target for inflation in Europe is 2%. Here it's 2%, but right now the Fed's last Q4 of last year, they came out and said they're going to target employment more than an inflation target. They're going to purposely let it run hot, and boy, are they. So across Europe, inflation's at 2.2. I'll remind you that inflation here in the U.S. is at 5.4, so it's double, more than double over in Europe, primarily because Europe's been shut down a lot longer than the U.S. Okay. So we're getting some of that going on. Then, of course, if we go over to the Asian markets, you can see the Nikkei, China, and the Hang Seng all in the red. Not only horrible down market move for the week, but also year to date in the red. Okay, really strong in the red. So just really a tough time. And I will tell you, the U.S. is the largest economy on the planet. Number 2 is China. Number 3 is Japan, if you don't count all of the European zone as an economy. And if you look at the second and the third place economies, ranking-wise, they're solidly in the red for the year. So globally, we're not going anywhere as long as number 2, China, number 3, Japan are in the red, and they're having hellacious fits and starts with their economy. Now, China is down more for other reasons because they're just decimating their technology industry. President Xi does not want technology to be stronger than the government, like it is here in the U.S. So he's stopping a lot of things that technology companies are allowed to do here in the U.S. that they will not be able to do in China, and it is killing the tech industry. I told our members months ago to get out of Chinese stocks like Baba, Tencent, JD.com, all these others. They're just getting crushed. Don't try and catch that falling knife because I think it's got further to go. But President Xi does not care if he puts his economy in a bear market. They've come close a couple of times. He does not care. So meanwhile, if we look at Japan, their markets finished really, they just took a big hit when Toyota came out and said they're cutting production for September by 40%, right? And Toyota is one of the biggest exporters in Japan. And that really just kind of set their economy for a loop, or at least their index anyway. The government's decision to extend their COVID state of emergency also kind of dampened sentiment as well. We did see Japan's GDP expand 1.3% in Q2 of this year, ahead of consensus estimates. but it followed a 3.7% contraction in Q1. So they're net, they're still, pretty much underwater for the year, GDP wise. So Japan is just, it's not a really strong place, right? And the other big Asian markets that we follow, China and Hang Seng, Chinese stocks are just getting killed by, as I said, Xi's regulatory clampdown on their technology. He's just killing them. Not only technology, but education and others. He doesn't even want those companies to take credit card information. He does not want the tech companies to hold all of that information and know more about it, the citizenry, than the government does. So they're clamping down big time. The markets in China and Hong Kong have lost more than half a trillion dollars in market value since they started doing this mess. It's just crazy. The other thing, the yuan or the renminbi, which is their currency, hit a 3-week low against the dollar at 6.5059. The psychological value, if it breaks this, it'll go much lower, 6.5. So they're having a hard time there. And on the economic front in China, too, their monthly indicators are showing that they're missing expectations as their economic activity is slowing. We're also seeing some heavy flooding and COVID breakouts with the Delta variant. They're shutting things down. So, all in all, just a very dreary place to be. China, Japan, the Asian markets all getting clobbered. That's going to dampen economic growth globally. As I said, they're number 2 and number 3 globally as far as major country GDP. So they're just going to slow things down. That's another reason why oil came out of the best sector performance year to date, because oil is a global thing. If energy economy is slowing down, so is that. Now, this week, we got a key thing coming out that you guys need to be aware of. We got the confab meeting in Jackson Hole, Wyoming, of the muckety mucks of the muckety muck factory. That would be the central bankers from Japan, Canada, the US, the ECB, Great Britain, all of them. China's not going to be there, and Russia, of course, won't be there. But it's going to be some of the largest powerhouses. They all meet in Jackson Hole, Wyoming. Every year they meet, and then they come down from the mountains with their tablet with etched in what they're going to do. Now, Boom Boom Powell pretty much is the highlight speaker because the US Feds kind of drive global markets. And Boom Boom Powell, that would be Jerome Power Ranger Boom Boom Powell, is what I like to call him. He's going to be speaking at 10 a.m. Eastern Time on Friday, that's August 27th. Now it runs through the 28th, but the highlight of the entire confab, it goes from the 26th to the 28th. So Thursday, Friday, and Saturday. But Friday is his highlight speech, 10 a.m. Eastern Time. If he comes out and he basically says the Feds are going to, if the speech is determined, and you'll be able to pick it up on the internet, probably on Bloomberg channel or some other TV business channels. If he basically is more bearish than dovish, and it's all about expectations, guys. If he comes out and he's more bearish than expected, you're going to see the market sell off big time. We'll have another hard down week. Okay. If he's neutral and he's at expectations, then we should have some chop in the markets leading up to the speech. If he's dovish, you're going to see the markets take off. This will be bigger than his press conference because the speech is entirely about what their economic outlook is for 2022, 2023. And these muckety mucks very rarely get it right 30 to 60 days out in time. So when they go out a year or 2 years, I've never seen, and I've been doing this for a long time, them get it right. Okay, that far out in time. So, but it doesn't matter whether they're right or not. It's just what he says is going to drive price action. So we got to follow this very closely. So make sure you mark your calendars Friday, 10 a.m. Eastern Standard Time, August the 27th, Jackson Hole, Wyoming. Boom Boom Powell is going to pull out his tablet coming down from the Grand Teton Mountains, and he's going to say, and he's going to lay it on the line. Okay. So let me take you over to the charts, and I'm going to show you a couple of key indicators on the charts, primarily the E-minis. And the reason why I focus a lot on this free weekly roundup with the E-minis is wherever the E-mini S&P 500 futures go, everybody else tends to follow. Okay. And granted, you can have a divergence between the S&P and Nasdaq and the Russell and the Dow, but generally you don't get a divergence too far, right? If you do, then it's usually a tradable event. And members, we tend to look at these divergences as tradable opportunities. But for now, what I want to do is I'm going to take you over and I am going to show you the E-mini S&P 500 future. So let me just switch the screen here real quick for you. Let's get it over here. Right here like this. So what you're going to see is I'm going to wait until we get it up on the screen. And I'm going to show you again, the buy the dip crowd is still very active and very strong. And I'm going to prove it to you by just looking at the charts. All you got to do is use the charts, right? And it'll tell you where the buy the dip crowd tends to come in. You can see here again, intraday, we just about kissed the 50 EMA, followed by a very, very strong green bar up day. So the buy the dip crowd is coming in. You can see right here, it was the same thing, even intraday, but the very next bar, we look for follow through. The very next bar, it was a green bar again. Right here, we came through the 50 EMA, but the very next bar, a green bar. So it's a buy the dip. And folks, it's been like this all year long. You use the 50 EMA as an opportunity to follow the buy the dip crowd. And you can front run it or you can wait till the next day. So this would suggest on this candle here, we're going to move up over and make new 2021 all-time highs. Now, we're getting very weak. We got a little bit of a divergence in the MACD. We call it a poor man's divergence. That flat move there, that flat move there really is nothing more than consolidation in the markets. Even though we're moving higher, sometimes the markets consolidate over time versus overpriced. And here, it just shows you how much money is flowing into the markets because a lot of people that are not in the markets or a lot of funds that are not in the markets hate missing out on up moves and they jump in. There's no place else to go. They can't. The 10-year Treasury is less than the dividend yield of the S&P. So what do these big firms do? They buy a basket of S&P, right? And then they just collect the dividend or the spiders. Excuse me. So that's what they're doing. Now, let me just back this out. So granted, this chart goes back to May, the end of May. But let me just take you through the entire year just to show you. And it's truly an algo-driven buy the dip crowd. And let me just take it back through the end of May or through the beginning of this year, right? All right, so right here. Excuse me, guys. Let me get a drink of water. Hang on just one. Let me do this for a second here. Let me get a drink of water. I'm going to put you guys on mute for a second. Sorry, guys. I just had something stuck in my throat. So, if we look at this through this year, every time we've touched the 50 EMA, 1, 2, 3, 4, 5, 6, 7 times. The very next bar was a green bar. 4 of these times we closed below the 50 EMA. All 4 of those times the very next bar was green, taking us above. The other 3 of those times we closed intraday or touched the 50 EMA, and every time the very next bar was a green bar. Okay, so basically, and granted, we've got a longer term divergence setting up, but the further out in time you go, the less valid these divergences become. But we do have a valid divergence here. But what's happening is that the money that's coming into the market is not what I call enthusiastic money, meaning as we go higher, it's a grind higher. But right now, the buy the dip crowd is using the 50 EMA. Now, eventually that's going to break. And in our studies, Typically, when the 50 EMA breaks, we go another 5% down, right? So right now, if I just look at it, the 50 EMA, we were down, what is it, 2.77%? That's nothing. But add another 5% to it, so that put us at 7.77. So that would put us right at that pivot point there, right around 41.25, okay? The 200 EMA is sitting in correction territory at 10%. Now, I was calling for a 7 to a 12% pullback before the end of August, early September. This is just like last year. I said the same thing last year. We had a 10% correction in September. Guys, every year we generally have 2 5% pullbacks or one 10% pullback. Every year on average, going back a half a century. Granted, some years we don't have them, and other years we have 2 or 3 5 to 10% pullbacks. But we haven't had one in quite some time. More than 180 days, consecutive trading days to be exact. The last pullback that we had of significance over 5% in the S&P now was in September of last year. But now let me show you the Russell. If we look at the rut, and where is the rut? Right here. We actually had a 10% correction right here from the highs, okay? We've had an intraday correction. Let me just kind of put this on the screen here. We were actually right here. We had a correction right here on that candle. We had a correction on that candle. We've had a correction there, right here after we made our highs. So we've had 1, 2, 3, 4, 5, 6 days where we've been in correction territory at the bottom of this wide zone. Now, the Russell 2000 tends to lead the market up and down. Generally coming out of an extended bear market, you want to be long the Russell because that's going to move the biggest to the upside. As we're forming a top and we pull back, you want to be short the Russell because the Russell tends to lead the way down. And you can see we are well below the 50 EMA. The 50 EMA is pointing down. We're not in correction territory now in the Russell, but we're down a pretty good bit from their all-time highs, right? Now, I'm not talking about up for the year off where we opened in January. But if you look at it, we are down about 8.46%. We're only down about 2.7% in the S&P and the Dow, Nasdaq around that level. Russell, we're down almost in correction territory. So if we come down and test and fail the 200 EMA, I believe we're going to break the 50 EMA on the S&P. So guys, if you do anything else, just follow the S&P and use that as a buy the dip moment where you're going to log in. Now, it does require a lot of you to have some patience. I know a lot of our free members that listen in on the weekend and others that send me notes and emails. You got the patience of a gnat in a frying pan. But here on the buy the dip crowd, you just got to watch it. And then you can front run it when it kisses the 50 EMA. And if you don't get that green bar, then you can expect another 3 to 5% lower, right? We're eventually going to break that down. If we look at Nasdaq, okay, Nasdaq is near all-time highs. You can see we came down, almost touched the 50 EMA, we bounced back up. So, you know, this week, I think the market's going to be choppy in anticipation of what Boom Boom Powell is going to say on Friday at 10 a.m. Eastern Standard Time, this coming Friday. It's going to be a big speech. It usually goes on for an hour. And the market's going to jump on it. I don't know whether it's going to go up or down. It's all about expectations. If they expect a certain thing and he says something contrary to expectations, dovish, we're going higher. Bearish, we're going lower. Okay. Keep in mind, the markets are already sensitive to tapering news. You saw what happened when Kaplan came out on Friday and said we may delay the tapering, or I would be in favor of delaying the tapering until Q1 of 2022 if the Delta variant continues to run rampant. And you saw the markets just moved up hard. If he had said the opposite or he's in line with that, then I think Friday would have been a neutral to more of a down day. So I do believe we're going to give it up more. Again, I'm looking for a 5 to 10% pullback now, and now probably through the month of September. August and September tend to not be kind to the markets. So at a higher level, that's what I would see. If we look at our FANG index, you can see here, it is off of the highs, all-time highs on this index made at the end of July. August, we've been pretty much running sideways, although we did move up on Thursday and Friday, all right? But the Russell, and then the other one is the Dow Transports. If you look at the Dow Transports, look at this, guys. This is not a bullish chart. I had a target down here, as I showed our members last Sunday, of 242. Even though we're moving up, I had expected a rollover back in the channel, and that's what we got. You can see, if I blow it up a little bit, you can see the failure at the 50 EMA. And that's a classic bear market pattern where you add to your shorts. You can see right over here, we had red bar, green bar, red bar, green bar, red bar, and then we broke. So we spent a week at the 50 EMA. We could not clear it. We came down, we did another test at the 50 EMA, could not clear it. In a bear market, you look for a price to run up and kiss the 50 or the 200 EMA, and if it fails, you want to add to your shorts. We come back down. We come up, we could not even get up to the altitude and escape velocity to get over it. We came back down. We came back up. We actually cleared the 50 EMA, but we could not get the escape velocity to run higher. We broke, and now we're back down here again. I'm calling for it to run down, take out these lows here, and make new lows. So that would suggest, again, the Dow Jones Transports tends to lead the markets, right? And this thing, that's a bearish channel. It's a regression line, but it's a bearish channel moving to the downside. And we generally tie the transports to the Dow. The Dow, as you can see, kissed the 50 EMA and held it. Okay, over here, it closed below, green bar next. It closed below here. We had a little bit of a follow through, and then we came right back up again. On that follow through, when we moved lower, right there, we just moved lower. We moved down an additional, what is that? An additional 2.7%. The S&P, when it broke the 50 EMA and had another follow-on red bar, it fell an additional 5%. Okay. Remember, the Dow is mostly mega cap international stocks. They get the bulk of their profits internationally, not in the U.S., over 60%. So they tend to follow a lot international. And if we look at an international index, VEU, it's kind of a global index from Vanguard. This is not very healthy. If we look at the global index, you can see we tried to get escape velocity. We could not get it. And if we look at where we're sitting, we're down year to date right at about where it closed, about a little over 5%, right? Now, I'm going to show you China through Asher. Asher is getting crushed. You can see right here, we were in a bear market from the highs. Let me just get this right here so we get the all-time highs on here. So you can see from the all-time highs where we're sitting. It closed this past Friday right around 19% down, right? Almost in a bear market. It was in a bear market over here, about 22% down back on the end of, going to the end of July. But we're in bear market territory, right? We're below the 2020 closing price. So we're in bear market territory for this. And I'm going to show you here. Let me just see if I can find it. Let's come down here. And let's look at China ETFs. And I want to show you the technology focus. Look at KWEB. Look at this chart. I'm going to put it on a weekly just to show how ugly China has been to their technology sector. Look at that. It was up at 105. Now it's down at 44.09. We're challenging this area here. And if we take it out, you can see this is a solid support zone. So I've had some members just holding their breath and coming in here and going out in time and buying some leaps. Now, keep in mind, there's high volatility here, so you're going to pay a lot of money for those leaps. So you may want to, if you do a leap, which is a option contract greater than 9 months, you know, you can, I don't know what the bid-ask spread's probably pretty wide, but they're trying to play long positions in some of these. Now, it is like catching a knife. You can see the MACD, it shows no signs of letting up on a weekly, but if we go back to a daily again, you can come on here and try and play these bounces. But the bounces are short-lived. Very rarely does the bounce last more than 4 days, 3 or 4 days, and then it rolls right back over again. You can see this 50 EMA. This is considered a bear market, right? And if we look at it to show you where they are down year to date on this thing, that was the high point. Year to date, it is down about 58%. That was how far down we fell in the crisis in '08 and '09 here in the US for our indexes. So they're down about 58%. This big solid support line is another probably about 62% down. So if you want to just pick up a couple of shares, close your eyes, and then look at it a year from now, it may run sideways. It may have a bounce back up. And you can try and catch a falling knife. So what I'm going to do with our members is we're going to look for a trigger to go long. We're starting to get some divergences here on this thing, so it could be an interesting contra play. But if we look at some of these China traded stocks like Tencent, same thing. Straight down, just getting crushed. JD.com, right? Look at these. These were strong stocks as of February. And now they're back down. They've just gotten crushed. Or how about Baidu? Baidu is just a very well popular stock. It's gotten crushed. BABA, let's look at BABA, another strong Chinese stock. Totally crushed, right? And when it started this thing, it was up around 320. Now it's down around 157. So, 50% lower, roughly a little bit more than 50% lower, every single one of these. So this is why you got to be very careful. China's just totally punished their tech industry, totally taken them out of the game, right? So if we come in here and we look at bonds, we look at the bond market. It was flat on Friday. Now the bond market, I like shorting the bond market up here, okay? I think eventually bonds are going to come back down. If we do get that additional pullback to give us a 5 to 10% pullback, you're going to see the bonds spike up in this area here. I would use it to short bonds and not go long, all right? And that means you're going to want to go long interest rates. If we look at the 10-year rates, you can see here with the 10-year rates, I had projected up around 1.9% going out in time into the end of this year, but I think that may be a little bit too much. But I do believe you can see where we tried to get up over the 50 EMA right here. And you can see, again, in a bear market, use either the 200 or the 50 EMA. And that's where you add to your shorts if we're going below, or to your longs if you're above. Right here, we couldn't get up above it, right? We closed one day above it, no follow through. The next day was a red candle. You want to play short. We're probably going to make another run up here. If we get up above it and then we have a green candle as follow through, that would be a trigger to look at going long TLT, or, long interest rates, or short TLT, right? The ETF. US dollar, it's confounded a lot of folks. We're up at this level. We made new 2021 highs. Let me just move this down here, right in this level here. New 2021 highs right here. But it's an Elliott Wave 5 higher. I do believe this thing is going to run out of steam. Once we get through September into the end of the year, the dollar is going to be back down around these levels right around here. These are pretty good support levels down that area there. It's going to be back down there. But for now, we're getting strength in this with the Delta variant, okay? So these are just some of the things I see. Oh, and by the way, gold, longer term, I'm bullish gold. Short term, we're flopping around here inside this triangle. We came out, we had kind of like a flash crash in gold here. It fell a couple 100 and 200 points really quick. Came right back again, okay? But I think longer term, we're going to be long gold. I am not trading. I am trading gold. Our members are trading gold a special way with one of our strategies that we're probably going to have to roll out to 2022 or maybe even 2023 in the futures market. But I think longer term gold is going to be higher. Same thing with silver. If we look at copper, copper broke a major level here. Okay, let's just take a look at it here. It broke a key upslope and trend line. And just show you how strong that trend line has been. If I take it out in time, right? That trend line started at the bottom of the COVID crisis. Everything crashed. And then we got long copper here about the second week in April. Okay. And we've been long ever since. And we just take it up. And we got out right up here on this pullback. We got long again, lost a little bit here on this move up, move back down again. But overall, net, we got nice profits in copper. But when we broke this trend line right here, we got some, we're trading copper a little bit more to the downside. I think copper's, if the economy does start slowing down, copper's going to come down even lower. So we're looking to increase our profits in copper, with the ETF that we trade to track that. Okay. And then, of course, oil, it fell out of favor on the year-to-date move in oil, and it was overtaken by real estate. But if you look at oil, look at that fall lower. I think as the global economy comes down, it hit my support area right there. We got a small support area in oil right there. But I think we may have a little bit of a bounce, and then it's going to run lower in oil. So you want to lean neutral to short in the oil markets near term. MACD is just ugly, 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 ugly. So oil is no longer leading the pack. Nat gas, as you can see, goes the opposite of oil. Nat gas came up in this area here. I did suggest to our members to play this to the downside. I put a couple of trades out there, and some of them are making nice money on it. I think it's going to find support around this area here, but that's kind of where we would play in the nat gas market. All right, everybody, that's kind of where we're sitting. If you're not a member, I highly encourage you to come in and check us out. We trade everything, currencies, commodities, and U.S. equities. But we play them with options and commodities and futures and stuff. Because there's a bull market somewhere, and there's a good solid bear market, and we like playing these things. All right, everybody, members, I will see you this Sunday evening in our weekly market watch. If you're a non-member, love to see you come in and join us. Otherwise, have a great weekend, everybody. I'll catch you guys later. Ciao now.